Well, hello and welcome back to Principles of Accounting 2. I'm still your host, Dr. B. Happy to have you with us. Over the past 2 weeks, you all have been very engaged in QuickBooks. And over the past 2 weeks, you completed two LinkedIn Learning certificates on QuickBooks. Uh, Excellent work, by the way. I'm very happy for all of you, very proud of all of you for all of the work you've been doing in this course. I know it's not always the easiest, but you've all been keeping up with it, and I sincerely appreciate that. So, the work you're doing has been excellent and continues to be excellent. So, thank you all so very much for continuing to push forward and trying your absolute best in this course. So I sincerely appreciate your efforts. And I know you probably don't hear it enough, but thank you, thank you, thank you. Okay, I want to call your attention to where we are in the classroom today. We are beginning week 10. Our conversation today is going to be on budgeting, which is one of my favorite topics to talk about. Uh, and I'll explain to you why. And then next week we'll continue our conversation with budgeting and this concept called standard costs, and so that'll be another interesting conversation for next week. So let's go ahead and talk about budgeting, shall we? So I'd mentioned budgeting is one of my favorite concepts to talk about, and the reason for that is because a budget is designed to give permission to spend, basically. It's a roadmap, it's a plan, it's a way for us to say, this is what we have available, this is what we plan to spend it on. That's a budget, right? Every household has a budget. You got money coming into the household and money going out of the household. And as long as you're not spending more than what you're taking in, you got yourself a balanced budget. Right? The same exact concept applies in business. We project that we will receive sales from our customers. That's what we call projected revenue or forecasted revenue. We expect to collect X amount of dollars from our customer this year or next year. And then we plan to spend on X, Y, and Z, our expenses, right? That's a budget. That's the idea of budgeting. A budget gives us permission to spend, and it gives us an idea of how much revenue we're going to collect from our customers and how much our expenses are going to be. That's the idea of a budget. Your household has one, the business has one, and the government is supposed to have one. Although we know that Congress can't budget their way out of a paper bag, they're supposed to have a budget. Okay. So let's talk about this whole budgeting thing, and I'm going to go through the steps of preparing a great budget, and I'm going to talk about the importance behind each step. So first, we'll talk about the benefits of budgeting, why we do it, how to prepare one, and then I'll also explain the overall purpose. So first, why do we budget? Well, the reason for a budget, as I'd mentioned, is it gives the business a formal plan for the future. The budget tells us the expected amount of revenue to come in and all of our expected expenses to go out. Okay? It's a plan in the form of dollars. That's what a budget is. And the way that we budget is through what we call the budgeting process. Budgeting is, of course, a process where we plan for the future revenue and expenses. I'm going to give you some real life examples from my experience. So, those of you who know, I worked in the hotel business for a long time. Okay. And in the hotel, we had several different departments. We got the rooms division, which is the front of house, right? The rooms division covered all of the banquet space, it covered all of the guest rooms, it covered all of the front of house stuff. Yeah. We also had a restaurant. So we had rooms division, a restaurant. We also had the sales and marketing department. We had the back of house, which included um, back of house services. That could be things like engineering, um, general maintenance, etc. And then we also had a few other smaller departments like human resources and accounting and administrative departments. Each department had its own budget. So for me, as the assistant financial controller and then eventually the controller of the hotel, I would approach each department manager and say, okay, department manager, I want you to prepare your budget for the next fiscal year. So I would tell them what the expected revenue would be, and they would in turn provide a line by line budget of what they plan to spend during that fiscal year. And I would collect each department manager's budget from them and put it all together into a single budget for the hotel. We called this the master budget. Why is it called a master budget? Because it includes all of these individual budgets together. You see? So that's my real life example. Well, the idea is we use the budget to plan and execute on the plan for future results. And then as the results would come in from each month, I would track the actual expenditures to the budget and say, are we on track? And I would look at each line item, right? And identify any differences. And then if there was a change, let's say 1 month we came in under revenue, we expected to sell this number of rooms, we only came in at a lower number of rooms, so the revenue is lower. In that case, we need to take action and make adjustments, yeah? And then we learn from all of this, and then we set new plans in motion, and we do the whole process again. This is what we call the budgeting process. So it's really 4 steps. First is to develop the budget from the planned objectives. The second is to compare actual results to the budgeted amounts and analyze the differences. The third is to take corrective action. And the fourth, of course, is to establish new objectives and ultimately create a new budget for the following 12 months. You see? So that's the budgeting process. And it's cyclical. We do it every single year. So, a couple of benefits to help us guiding us through the budgeting process. The first, of course, is a plan. The budget focuses on future opportunities and threats to the organization. Now, the idea here is that we're developing a plan for operating in the future. That's, of course, a benefit to budgeting. The second is control. Control function requires management to evaluate, also known as benchmark, operations against the normal performance, operating performance. The idea here is that we're comparing our budgeted performance for the company, and we're comparing that to industry performance, economic indicators, etc. It gives us control. So that's another benefit. The third benefit is called coordination. This is where the budget helps us to coordinate activities so all employees and departments understand and work toward a common goal. Oh, I'm sorry. The fourth benefit is communication. Written budgets effectively communicate management's specific action plans to all their employees. The idea here is that one of the benefits of the budget is a part of the communication plan. And the fifth benefit is motivation. Budgets can be a motivating factor for employees. The budgeted performance levels can provide goals for employees to attain or even exceed. That's the overall idea here. So budgets can be motivating, which is, of course, another benefit. It's also important to understand that budgeting is a product of human behavior. What I mean by that is that human behavior influences how budgets are made and executed on in both good and not so great ways. So, budgeting can be really good for individuals because a budget reflects goals that can be attained but are challenging. When they're attained and they're challenging, that's a good thing. Good human aspect. The employees work together to help to prepare the budget in a team atmosphere, right? That's the idea here. And then the third positive factor is that evaluations offer opportunities to explain differences between actual and budgeted amounts. When there's a difference between the actual and budgeted amounts, it provides that opportunity for somebody to explain exactly what happened. So those are all good things. Here are some not great things from budgeting. Sometimes a budget creates what we call undue pressure to meet the results. When employees engage in unethical or fraudulent behavior in order to meet the goals. Right? For example, a salesperson might be might feel obligated to sell more. So how do they do that? Maybe they make some type of deal that's on the side, and that's not really ethical, right? But they feel pressure from the budget to do so. So it's kind of a negative thing. Another negative thing is employees might, and this one drives me nuts, and I'm going to give you an example of this. Employees might understate sales budgets and overstate expenses to allow for a cushion. We call this padding the budget to allow for slack, what we call budgetary slack. This drives me crazy, and let me explain why. I've done some consulting work recently for a couple of small businesses that do this. They'll purposely benchmark their sales or estimate their sales lower than what they expect them to actually be. And they'll also purposely show higher expenses than what they might be. Now, why would they do this, you might ask? The idea here is that the company wants to, look like they're doing real well, right? My my estimated sales were this. I came in way higher. Well, that makes them look good, right? Or my expected expenses were supposed to be real high. They came in a lot lower. Makes them look good. But the reason why this is a bad thing is because it's kind of a short sighting, right? Because otherwise they could have been closer to what the expectation was. It would have helped them to be better operationally. So that's why that type of thing is negative. The third is that employees might spend budgets on unnecessary items to ensure the budget is not reduced in the next period. This one drives me crazy too. This is number 3 on the negative side. My favorite example from this is of the government, the federal government. I don't know if have you ever heard about the the golden toilet seat? You ever hear about this? Some of you might have heard about this, and if you've served in the military, you probably heard about this. So, Afghanistan. This was a very unpopular war, as you may recall, and the federal government had a very large um, military budget that year for those years of that war. And one of the things that they had spent all this money on were like things like warehouses and and then of course the necessary stuff like weaponry and storage and et cetera, et cetera. So there was a year where the military needed to spend their budgeted amount. Otherwise, they would risk not receiving the same amount next year. So they quickly scrambled and were like, oh, we need to spend all this money. So they ended up purchasing uh, golden, and I'm not exaggerating when I say this, golden toilet seats. They're made out of gold, right? You can imagine that's really expensive. But they did that in order to make sure that they got the same amount of budget for the next year. Yeah, it's that kind of stuff drives me insane. The government is notorious for doing this. Okay, uh, budgets. We typically do that for a full fiscal year, a full 12 months. Okay, remember in business, a fiscal year is not necessarily the same as a calendar year. A calendar year runs from January to December, right? That's a calendar year. A fiscal year is a set of 12 consecutive months. It doesn't necessarily follow a calendar year. Not all businesses started in January. Some might have started in February or March or April. For example, I've recently started doing some consulting work with a soul food restaurant in North Carolina. And the owner of the business, she just started. She just started the business in March. So her fiscal year started March 1 and will end February 28. You see? It's a full consecutive 12 months. For budgetary purposes, we follow whatever that fiscal year is. We budget for a full 12 months. Now, here's how a rolling budget works. Because budgeting should be continuous. We don't want to just stop and then wait until more time lapses before we budget again. We want to continuously budget. We call this a rolling or continuous budget. With continuous budgeting, we're continuously revising budgets as time passes. For example, my new client, she started the business this month, March 2024. We got her budget created through February 2025. At the end of March 2024, end of this month, which is in like 2 weeks, we're going to create the budget for March 2025. When April 2024 ends, we're going to do the budget for April 2025. You see, we continuously have a full 12 months of budget in front of us. We call that a continuous or rolling budget. Okay. Developing the master budget for any business is really, really important. And we start every single budget with sales. Okay? We budget based off of what we expect to receive from our customers. and it's based off how much we expect to sell, right? So we start every budget with sales, right? The revenue, because that helps you to plan for all of your expenses, right? I can't plan for my expenses unless I know what my sales are going to be. You see? So this is what we call the master budgeting process. And I'm going to walk you through how to create a master budget. And of course, because this is Principles of Accounting 2, and we talk a lot about cost in this course, we're going to do it from the perspective of a manufacturing company, where we need to budget for production of products. That includes, of course, direct materials, direct labor, and factory overhead. So here we have the framework of a master budget. The master budget is a formal comprehensive plan that contains all of the interconnected budgets. Okay, we start everything with sales. Sales are the expected sales we're going to make for the fiscal year. All right. I plan to sell 1,000 units every month in my fiscal year. That means I'm going to sell 12,000 units, okay, of whatever product I'm making. I'm going to sell 12,000 of them for the fiscal year. That's 1,000 a month, okay? So I need to figure out, based off of that number, I multiply that by my sales price, 12,000 times my sales price. We'll say, I don't know. I'm just making stuff up. Let's say it's I'm selling 12,000 of them, of these units, and the sales price is we'll say $10. Okay, so $120,000 of revenue, right? So $120,000 of revenue, that's my sales. How I got that is I multiplied $10 times the 12,000 units I expect to sell. That gives me my sales budget. Okay, great. So I expect to sell 12,000 units. That means I got to produce, make, and sell 12,000 units, because I don't have any in inventory at the moment. So the 12,000 units I need to make, I got a budget for that, right? I got to figure out how much I'm going to spend on direct materials, direct labor, and factory overhead to produce the 12,000 units. So I create what's called my production budget. The production budget tells me how many units of direct materials I need, how many direct labor hours I'm going to use, and how much factory overhead I'm going to use to produce the 12,000 units. You see? So once I do my production budget, it informs my direct materials budget, direct labor budget, and factory overhead budgets. Once I've done all of those budgets, they help to inform my cash budget. The cash budget tells us how much cash we're going to need to use based off of all those things, right? The sales budget also helps us to inform our selling and administrative expenses and our capital expenditures, which also help to inform the cash budget, right? Capital expenditures, as you know, are the purchase or sale of property, plant, and equipment, call those capital expenditures. Purchase or sale of property, plant, and equipment, that's capital expenditures. And of course, selling administrative expenses, those are related to the number of units I expect to sell, right? If I expect to produce and sell 12,000 units, selling administrative expenses are going to be 12,000 units times whatever percentage of sales commission, number of sales orders, etc. Yep. So that's the overall concept of a master budget. I'm going to walk through each of these in more detail with you. But first, I want to talk about the balance sheet. The balance sheet, as you know, contains all of our current and long-term assets, our current and long-term liabilities, and our equity. Assets equals liabilities plus equity is the accounting equation. Under assets, of course, you know that you have cash. There's a budget for cash. Accounts receivable, guess what? That eventually becomes cash. Inventory, raw materials, work in process, finished goods inventories. Property, plant, and equipment, they're all part of the budget, right? We have a cash budget, which includes cash and accounts receivable. We have a production budget, which includes raw materials and finished goods. We have a capital expenditure budget, which includes equipment. You see? That's why looking at the balance sheet helps us to inform our budgeting process. You see? So we have an example here. Our company creates hockey sticks, okay, in Toronto, a place where they play hockey. We produce hockey sticks. These are our balances, okay? So keep these balances in mind because I'm going to show you how these balances came to be. As I mentioned, the first thing we do in budgeting is to create the sales budget. Everything starts with sales. So the way I create a sales budget is by quarter. I can also extrapolate it out to a full year. But this company, they do it quarterly. That's okay. Nothing wrong with that. So here we have the fourth quarter of the year, October, November, December. In September, just before the quarter started, the company sold 700 hockey sticks at $60 each. So we prepare our sales budget based off of prior data. The prior data says that we sold 700 hockey sticks at $60 per stick in the month of September. In October, I expect to sell 1,000 hockey sticks. And in November, 800. In December, 1,400. Total hockey sticks I expect to sell is 3,200. Expect to sell. The word expect means we expect to do it. It hasn't happened yet. Ideally, this is what's going to happen. It's the budget. We take the number of units we expect to sell for that month and we multiply that by the sales price, in this case $60. That gives us the total budgeted sales amount for the month. For October, it's 60,000. You see, 1,000 times 60. And then we do the same thing for November, and then we do the same thing for December. Really, you do it the same thing for each month, right, of the year. So for this last quarter of the year, I expect to sell $192,000 worth of hockey sticks. I'm going to sell 3,200 hockey sticks at $60 a piece. Ideally. Okay, so now that I know that I'm going to sell 3,200 hockey sticks for the last quarter of the year, I need to figure out how many hockey sticks do I need to produce? Right? It's the second part of the budgeting process, the production budget. So in order to figure that out, you need to look at the balance sheet. Why? Because the balance sheet shows me finished goods. This is the number of hockey sticks I have available, right? I got 1,010, it looks like. So that's an important detail to remember. So let's create our production budget. Here we go. So the production budget, we got to figure out how many units we need to produce. How do we figure that out? We take our budgeted ending inventory units plus the budgeted sales units minus the beginning finished goods inventory units. Okay, that's the formula that tells us how many units I need to produce. So let's figure it out in Excel. Come over to my Excel document. I open it up and create the production budget. I do it based off of the sales budget data, right? And of course, what was on my balance sheet. So here we go. Let's start with October. I expect to sell 1,000 units. Okay, at a sales price of $60 a piece. Great. First, I need the first part of that formula was I needed to add in the desired ending inventory. Okay, the desired ending inventory in this example is 800. I want to end the month of October with 800 units. That's what desired ending inventory means, what you want to end the month with. I want to end it with 800. So that way it'll cover, November, right? I then multiply the 800 by 90%. Now, why 90%? 90% represents the budgeted November sales. Okay? It becomes the ending inventory for the next month, November. That's what this little line represents. So 800 units times 90% is 720. That's the desired ending inventory units. I then add that to the budgeted number of units I expect to sell, 1,000. So the total required units for the month of October is 1,720. I then subtract out the beginning inventory, 1,010. That came from the balance sheet. That means I need to manufacture 710 units. 1,720 minus the 1010. So 710 units is what I need to make in the month of October. I follow the same process for November and December. November, expect to sell 800 units. I got next month's budgeted sales times 90%. That gives me 1,260 units. I add that to the 800 that I expect to sell. That gives me 2,060. Minus the 720 units ending inventory from the prior month, which is the beginning inventory for that month, you see, equals 1,340 units I need to produce in the month of November. And I follow the same process for December. So that's the production budget process. But now that I know how many units I need to produce in each month, I got to figure out my raw materials, also known as direct materials. I got to purchase the wood for the hockey sticks, right? Raw materials, direct materials. I got to get my direct materials, direct labor, and factory overhead budgets based off of this production budget. Remember, the production budget tells us how many units I need to produce based off of my projected sales. So looking at the direct materials, how much wood, direct materials, do I need to purchase in order to manufacture 710 plus 1340 plus 950 hockey sticks, right? Got to figure out how much wood I need to purchase based off of that, of those calculations. So, in order to figure that out, I take the number of units I need to produce from the production budget times the materials required per unit. This is the amount of wood needed to produce one hockey stick. Materials required per unit. Plus the desired ending raw materials inventory. Minus the beginning raw materials inventory. That beginning amount, that comes from the balance sheet. So let me show you in Excel how we create the direct materials budget. So remember, direct materials budget tells us how much raw materials we need in order to produce that number of units. So looking at October, we expect to produce 710 hockey sticks. It takes half a pound of wood to produce a single hockey stick. 710 times 0.5, which is half. It tells me I need 355 pounds of wood to create 710 hockey sticks. I would like to have an ending inventory of 335. Of course, that's going to be the beginning balance for the next month. 335 also happens to be half of the materials needed for the following month. That's where that 50% comes from, yeah? So 355 plus the 335 means that I need a total of 690 pounds of wood. Minus the beginning inventory of 178 that came from the balance sheet, remember? This means I need to purchase 512 pounds of wood. The cost per pound of wood is $20. So I take the 512 that I need to purchase times the $20 per pound, giving me $10,240 worth of wood I need to purchase in the month of October. I follow that same process for November and December. November, I need to produce 1340 hockey sticks times half a pound of wood per unit. It gives me 670, which is half of the 335 from the prior month. 670, my desired ending inventory should be 237.5 pounds, which is half of the required materials for December, which means I need a total of 907.5 pounds of wood in November. Minus the beginning materials inventory from the prior month, 335, means that I need to purchase 572.5 pounds of wood in November. Times $20 per pound gives me 11,450. I follow that same process for December. You see, direct materials budget. This, if you follow those 5 steps, makes it nice and easy. Yep. Okay, so I figured out my direct materials or raw materials. Now I got to figure out my employees. I got to staff up to produce all these hockey sticks, right? So my employees make a certain wage. I got to figure out how much time it takes to produce a hockey stick. So, how do we calculate the cost of labor? We take the number of units to produce, how many hockey sticks I got to make, times the direct labor hours required per unit. How long does it take to make one hockey stick? In this case, 25 minutes. Well, I'm sorry, a quarter of an hour. Quarter of an hour. Times the labor cost per hour. How much am I paying my employees per hour? Right? Do those together, we find the cost of direct labor. Okay, very simple three-step process. Number one, enter the units to produce from the production budget. 710 in October, 1340 in November, 950 in December. Multiply that by the number of hours required per unit. It takes a quarter of an hour to create one hockey stick. So 0.25. I take the number of units I need to produce in October, 710 times 0.25. It tells me I need 177.5 labor hours in the month of October to produce the 710 hockey sticks. I multiply the 177.5 times the labor rate, cost per hour, $12 per hour, gets me a cost of direct labor of $2,130. I've used that same process for every month. Very straightforward, just 3 steps. Okay. That's direct labor. Now what about factory overhead? Factory overhead, as you know, includes things like indirect materials, indirect labor, utilities, other overhead, right? That's what factory overhead covers. So how do we calculate the factory overhead? First, we figure out the variable factory overhead. The variable portion of factory overhead is assigned a rate of $2.50 per unit of production. Remember, we call that the assigned rate. Yep. So $2.50 per unit. The fixed overhead rate is $1,500 a month. Remember, fixed doesn't change regardless of the level of activity. All right. So we have a variable overhead rate per direct labor hour of $10. Right? So we take the $10 times the number of hours needed per month to get the budgeted variable overhead. We then add the budgeted fixed overhead to get the total factory overhead per month. So those are the 3 steps. Do that every month, and that's your overhead budget. Okay, so we got the sales budget. We figured out the production budget. From the production budget, we figured out direct materials, direct labor, and factory overhead. All of these lead us to the next part, which is figuring out the total cost per unit. Here's how we figure out total cost per unit. We take our direct materials cost per unit. half a pound of wood, $20 per pound. That's $10. Plus, direct labor per unit. It takes a quarter of an hour. At $12 per hour, that's $3 per unit. Direct labor. Variable factory overhead. We take that quarter of an hour per hour times the $10 of variable overhead per direct labor hour. That gets us to $2.50 variable overhead. Then, of course, we have our fixed overhead, $1,500 a month, divided by 1,000 units for that month, gets us $1.50. Gives us a total product cost per unit of $17. Okay, now that we know how much it's going to cost us to create a single hockey stick, $17. Okay, I can now budget for my cost of goods sold. Cost of goods sold, as you know, is the cost of the product that you sold or plan to sell in this case, because it's a budget, yeah? So we take the number of units we expect to sell times the budgeted cost per unit. That gives us the budgeted cost of goods sold. And of course, now that I know my budgeted cost of goods sold, I can budget for my selling and administrative expenses. For sales, we take the budgeted sales amount times something like commission percentage. We pay our employees 10% commission on all their sales. For those of you who don't know what commission is, hopefully you do, but if you don't know what commission is, a commission is a percentage of the total sales that you've made. Okay? It's basically the way that the salesperson gets paid. Right? So in this case, 10%. 10% of 60,000 is 6,000. So that's their sales commission. It's the sales amount times the commission rate. In this case, 6,000 is what they would get. That's sales commission. Plus fixed sales salaries. We have a sales manager that makes $2,000 a month. Okay? That gives us total selling expenses of $8,000 in this example. So really, again, it's two steps. Sales amount, dollar amount, times commission percentage. That's step one. That gets us the sales commission amount. Plus the fixed rate, supervisor's salary, equals the total selling expenses. And on the administrative side, we have a general manager. Okay, that's it. General manager gets paid a salary. That salary's divided across the months. Take the total salary divided by 12. That gets you the amount per month. Okay, so we figured out selling and administrative expense budget. Remember, that was on the right side of that diagram I showed you earlier. On the left side, we have the capital expenditures budget. And then after we do that part, then we'll be able to create the cash budget. The capital expenditures budget, as you recall, is the purchase or sale of property, plant, and equipment. Okay? In this example, the business plans to purchase a piece of machinery for $25,000. Company plans to do that in December. Very simple. You just put the amount in whatever month the company plans to buy it in. Now that we have all of those budgets completed, we can create the cash budget. Okay. The cash budget. tells me how much cash I expect to collect from my customers each month based off of my sales. Okay? So here's how it works. This is the formula. Beginning cash balance from the balance sheet plus budgeted cash receipts minus budgeted cash payments equals the preliminary balance. If the preliminary balance is above the minimum expectation, then we can repay loans. If it's below that, we need to take out a loan. And that will equal our ending cash balance. That's the very simple formula. Now, let's take a look at our example. Here we have our sales budget, as you recall from the very beginning. September, my cash sales were 42,000. October is expected to be 60,000, November 48, and December 84. Now, there's a reason why I'm showing you the amount from September, because you're saying, no, Dr. B, you only showed us October, November, December before. With sales, as you know, sometimes you have customers that purchase on accounts receivable, right? They'll purchase and you'll say, oh, I'll pay you in 30 days, right? Accounts receivable. We need to account for collecting that receivable. You see, that's why I'm showing you the September amount. For this company, they collect 60% of their accounts receivable in the following month. So we made 42,000 in sales in September. That means in October, I'm going to collect 25,200. That's 60% of 42,000. Yeah. So if 60% of all my sales are on accounts receivable, that means 40% of them are cash over the counter. So 40% of 60,000 is 24. So 24 plus the 25.2 gets me total cash receipts for the month of October, 49,200. Follow the same process for November and December. November, 40% of 48,000 is 19,200. 60% of 60,000 from the prior month is 36,000. You see? And I do the same thing for December. The same thing for every month. That's the process. That's the formula. In business, timing is everything, especially when it comes to the collection of your receivables. Because knowing when you're going to collect your receivables helps you to plan for the future, for expenses, etc., right? So, using our cash budget that we just went through, we can extrapolate that out for us to understand further collections, right? We discussed uncollectibles. Remember? We had that conversation. This was probably, 3 weeks ago. We had a conversation about uncollectibles. I said, oh, sometimes customers don't pay. You know that. So we do what we call factoring to figure out some percentage that we might collect later down the road. So since we figured out our collections from cash and accounts receivable, we also need to plan to use cash for expenditures. Right? We need to make purchases. We got to purchase our raw materials using that cash that we expect to have on hand. So we prepare what's called the cash payments for direct materials budget. And here you can see that we pay cash for it. We don't do accounts payable, although you could. Which is the payments over several periods, as if we did it accounts payable. Yep. All that to say that we put together the total cash budget because we figured out how much we're going to collect from our customers. We figured out how much we're going to pay over time. Now here we are collectively putting together the total cash budget. At the top, you see cash collected from our customers from sales, and then eventually you see that added to from accounts receivable, and then minus all of our expenses: direct materials, direct labor, factory overhead, sales commission, sales salaries, administrative expenses, and then eventually income taxes, dividends, equipment purchases. All these are using cash, right? Remember, if the budgeted amount for cash is above the minimum, then we can pay down debt. However, if it's below the minimum, we might need to take out a loan. That's where you see the loan activity coming into play. So that's the formation of a cash budget. When it comes to paying back that loan stuff, we budget for that too, right? And we budget for the interest payments on those loans. So to make sure we have enough cash for the interest payment, we take the interest rate times the beginning balance of the loan in order to figure out what the interest cost should be. So now that I walked you through the master budgeting process, one of the final things that we do is to budget for our financial statements based off of the master budget. So here I'm going to show you the income statement, and then I'll show you the balance sheet. And then I think the statement of cash flows, if I'm not mistaken. So your budgeted income statement looks like this. As you know, your income statement has sales minus cost of goods sold equals gross profit minus selling general administrative expenses, and then minus sales tax or income tax expense equals net income. Right? This is the basic formation of a company's income statement in a very general sense. And this helps us to understand what our budgeted income statement should look like. So here we can see we would have net income of $59,254, which is good. We'd also budget our balance sheet. Our balance sheet, as you know, has assets, both current and long-term, liabilities, both current and long-term, and then, of course, our equity. Our cash balance budgeted comes from the cash budget. The accounts receivable comes from the cash budget. Raw materials and finished goods comes from your production budget, right? Your equipment comes from your capital expenditures budget. You see where we're going with this. And then, of course, we can follow this same approach for a service business. A service business is a business that provides a service. They don't sell inventory. A service business, an example of this might be a barber shop or a beauty salon or a tax preparer or whatever, right? A lawyer. They provide a service. So this would be their form of a production budget, right? A master budget. They have sales that they expect to sell. They have direct labor, the employees working at the firm, which leads into the cash budget. Of course, through sales, there's also selling administrative expenses, and most businesses have some type of capital expenditures. To prepare the direct labor budget for a service business, the formula is a lot easier. It's simply the budgeted direct labor hours times the direct labor cost per hour, right? So and then you just add across. Simple Excel spreadsheet should do the trick. From something like this, you could also figure out what we call revenue per employee. Revenue per employee is a ratio that helps us to measure the revenue generated per employee. It gives us an idea of how productive our workforce is. Okay, and to do this, it's very simple. Total revenue divided by total employees. We could also prepare a master budget for a merchandise company. Let's say your company purchases goods from a distributor, like Macy's, for example, and then sells those products to their customers. So Macy's purchases their products from their distributors and then sells them to their customers. This would be their master budget process. Sales budget goes to create the purchases budget, which creates the cash budget. And of course, sales also creates general selling administrative expenses and capital expenditures. This would be the purchases part of that budget. We would take the budgeted sales units plus the desired ending inventory minus the beginning inventory. This gives us the number of units that the company needs to purchase. Here we have a retailer that sells hockey sticks. Okay, we manufacture them. This is the retailer that sells them, right? So we take their budgeted sales, budgeted sales for the next period times the ratio for future sales, in this case 90%. Desired ending inventory plus the budgeted sales gives us the total required units minus the beginning inventory equals the number of units we need to purchase. You see it works very, very similarly to the manufacturing. Except that, of course, the only difference here is that we don't have direct materials, direct labor, factory overhead. We have purchases. And this is what their cash collection would look like for a merchandiser. Okay, my friends, this is the end of our discussion on budgeting. Are there any comments, questions, anything I could help to answer about budgeting at all? Do you think this was effective? What do you think?
Yeah, I think it was effective, Professor.
Right.
Now I know what my director of finance does when they do the budget, because I'm in hospitality too, so
Right. Yeah. Yeah.
all
So
those
that's
different
it.
departments.
That's exactly what that part of one of the many responsibilities that your director of finance has in the hotel business or hospitality business is budgeting is a huge part of it. Like just like when we started the conversation, the budget gives permission to spend. It's a roadmap on what to spend on, and so the process within a hotel, because it's more service oriented, is that each department manager has their budget. It's based off of the projected sales that the hotel or hospitality business has, and then they extrapolate it outward. It works the same exact way. Yeah.
Yeah, I see what he mean now. Sometimes when he be like, well, let me check and see where I budgeted to, like far as the codes and the department and stuff like that.
Exactly. Yeah. Yeah, and that part's kind of a pain too, because you know, we call them GL codes. They're general ledger codes, and
Yeah.
and the way it works is you have to code each line item, um, and if you screw it up, it's not easy to fix. So yeah,
Yeah, I've been seeing that we've been having to move some stuff around.
yeah,
Um, because some expense lines is a little heavy right now, and then it's kind of like the slow season, so we had to like move some stuff around,
yeah. We, c-
to make it make sense.
Yeah, we call that flexible budgeting, and that's actually a concept we're going to cover next week. With flexible budgeting, the way it works is we take what our projected sales are, we apply percentages, and we can say, okay, well, what would it look like at, we'll say, 25% capacity, 50% capacity, and 100% capacity. And we can make adjustments based off of those capacity levels, right? As we call that flexible budgeting, and we're going to talk about that next week. That's where your director of finance is coming in with making those kinds of adjustments.
Okay, sounds good.
Cool, awesome. Any other comments, questions, concerns? Oh,
No comments, no questions.
okay, very cool. Thank you, Oscar. I appreciate that. So let's take a look at for this week what we got going on. Your two action items are week 10 discussion board, and of course the quiz for budgeting. Now in the discussion board, we got 6 categories. The idea here is that you can choose any of the topics and extrapolate on them. Maria, awesome work here. So Maria went with the purpose of budget financial statements. She went through the whole. Yeah, great. This is fantastic. A lot of really good detail discussing what goes on underneath there, and that looks really well. And then Oscar went above and beyond and did 6. Extrapolated on all 6, and that's great too. So you have that flexibility to decide how you want your post to look. But Oscar, this is a great level of detail. This is exactly what I'm looking for. And same with Maria, very well done. So what I'd like you to do as you're writing out your posts is to look at what Maria and Oscar had done, and focus on those nice, lengthy, well-detailed posts, and then of course respond to each other, right? So ideally you should be responding to 2 of your classmates in this discussion, and that will make for a really good conversation. Yeah. But yeah, very well done to the both of you. And then of course the quiz. So I want to please have your initial discussion board post completed by Thursday, okay? Because that'll allow time for classmates to respond to each other, yeah? And if you need help, just let me know. I'm always around for you. But if you don't have any other comments, questions, or concerns, in the meantime, you can always email me, call me, or set up office hours. I'm always here for you. I sincerely appreciate all of your efforts in the course. I know that you're all doing very well, and let's keep up that positive momentum, and let's keep going. We got a few weeks left, and let's finish this course strong. Yeah. Okay. Thank you all so much for your time today. I sincerely appreciate all of you, and I hope you have a wonderful rest of your evening. Thank you so much.
You're the
You
same,
too.
Professor.
Bye,
Thank you.
Professor.
Appreciate you.